Hey guys, this is Alejandro and today we're going to be talking about how to fund your startup. Now here's the thing, funding your startup is critical, especially if you're looking at building a hyper-growth type of company. There's nothing wrong if you want to build a lifestyle business, but if you want to build $1 billion business, it's not about going alone, because if you go alone, you can go faster, but if you go together, you can actually go much farther. Today we're going to be talking about how you get all these people involved to really help you in giving you the money, giving you the networks, and making it happen. And by the way, if you stay until the end, you'll be able to find what is the number one mistake that most founders do when it comes to actually getting out there and getting their company funded. So first I want to talk about the startup funding cycle. Here's the thing, every company goes into different life cycles. So you're going to have every 18 to 24 months, there's going to be different people, different skill sets, different milestones that your business actually is going to unlock or is going to be unlocking. And every life cycle goes in parallel with a financing cycle where you're not only grabbing the money, but also the networks of the people that are giving you the money in order to unlock what is going to be the next life cycle of the business. So with that being said, you're going to start at an idea stage. Basically, you're just like thinking about it, what's possible. Then from there, you're going to go into a seed, anything seed, micro seed, pre-seed. It's going to be typically anywhere between 250,000 to 5 million. The median average is going to be around 2 million. But essentially, you're here looking at raising money from people that can give you, in addition to their networks, understanding about basically product market fit, validating your product, and then also helping you with operational expertise that they can bring to the table in order to help you in addressing some of the issues that you're dealing with. Essentially, at this point, you're raising money for the team, you're raising money for validating things, and again, it's all about the future that you're living into. That's ultimately what you're selling. Then you're going to go into the Series A. The Series A is going to happen 18 to 24 months later after the seed round. At this point, you have 1 million plus in revenue. You've been able to validate things, and you're raising money for the very first time from institutional investors like venture capital firms, because before that, let's say at a seed, pre-seed, micro-seed, it's going to be mostly individuals. But at a Series A, it's going to be the first institutional round where venture capital firms are giving you the money. And again, you're going to be wanting to get from those venture capital things 4 things. Number 1, access to talent. Number 2, access to subsequent rounds of financings. Number 3, access to distribution in the form of business development deals or partnerships. And number 4, basically M&A, either on the buy side to be able to achieve inorganic growth, or on the sell side to be able to get the best possible outcome for all the stakeholders. At a Series A funding cycle, you're ultimately raising anywhere between 5 to 15 million, and the median average is about 10 million. 18 to 24 months later is the Series B. At the Series B level, what you've achieved is remarkable, because now you're going from early stage company to growth stage company. You're actually raising over $20 million, but raising ultimately for getting the network from investors that are in a complete outside location from where you're at, in a different region, where they're plugging in their networks, their resources, so that they can replicate, help you in replicating what you've done in a completely different region. In this case, at a Series B level, as I mentioned, you're going from early stage to growth stage. But after the Series B, something amazing happens, and that is that every round after that is going to be more of the same in order to get you closer to the liquidity event that is going to happen in the form of an IPO, an acquisition in stock or in cash, or a blend of both, or a secondary where newer investors are buying out older investors. Now let's talk about the different types of funding sources. So the first one is bootstrapping, which is essentially your own customers are giving you the money. I find that bootstrapping was fantastic, let's say 10 to 15 years ago, but now being able to rely only on customer money, especially during the early days, is going to be very tough. You're going to be in very low oxygen, so any type of mistake could be lethal. So personally, I think that bootstrapping is great because you get to maintain equity ownership, but it's also bad because any mistake can be catastrophic. So again, that's for you to decide. The next source is friends and family. Friends and family, ultimately people that love you, they're not going to be doing a lot of due diligence on you. They basically are people that trust you. And again, those are going to be people that are going to be giving you the money typically on seed rounds. Check sizes, they could be anywhere from, let's say, $10,000 all the way up to $100,000, $200,000. But that's ultimately what you're looking at in terms of friends and family. Now, if you don't want your Thanksgiving dinners to get awkward, I would highly recommend against raising money from friends and family. The next one is banks and loans that they give you. obviously you have, let's say, the Small Business Administration, the SBA loans that have interesting terms for people that have, that are actually getting out there and starting out things. But banks, typically the terms that they will give you, they're not really beneficial. If you're, let's say, at a Series B plus already generating revenue, you can actually raise what is called venture debt, which is essentially raising money which is going to be mainly debt. It needs to be repaid, and that's going to be against the assets and the receivables of your business. So if you are more down the path of being a growth stage company and you have solid revenues that you're presenting, perhaps raising debt could be a really good way to avoid dilution, like going through an equity raise. But again, you got to be very careful because you need to put yourself in a position and a situation to be able to return that money back to those banks. Otherwise, you will put yourself into some big trouble. The next one is crowdfunding, which you have two blends. You have the donation-based crowdfunding like Kickstarters or Indiegogos of the world, and then you have the equity-based crowdfunding where you have like Seed Invest, Start Engine, and a bunch of all those others. Donation-based crowdfunding like Kickstarter is fantastic when you are pre-selling your product. You're ultimately raising money, and in exchange for the people that are giving you the money, you're giving something tangible. Especially if you're a consumer's good type of company, I think it's a fantastic way to get the name out there, to get some praise, to get distribution, to get early adopters of what you're doing. But if you're, let's say, like a high-tech type of operation, what are you going to give? Beta testing and things like that? I don't think it will be that appealing. On the other end, equity crowdfunding is really interesting. It's really interesting because it's a good way to raise money. The only problem is that you're going to be raising very small checks, and that could put you in a tough situation because those are going to be unsophisticated people. The problem, too, is that there is a lot of regulations that were introduced by the Jobs Act in 2012, and that is a lot of hurdles and regulatory restrictions that you're going to have to go through and reporting that you'll need to do that could be a little bit of a pain in the neck. So again, equity crowdfunding, the problem too is that it has some adverse selection, meaning that investors would see you as the last resource or route that you needed to take in order to raise money because perhaps more the traditional and sophisticated people did not want to give you the money. So again, there is a perception of adverse selection that you may need to navigate. The next one is angel investors. The angel investor term came from those that were financing some of the Broadway shows, and that they called them like that because it was a very risky type of investment. And now angel investors, that's what it's all about, is people that are sophisticated and professional at investing in early stage companies. Typically, those angel investors are going to be investing at a seed stage or anything seed and before, pre-seed, micro-seed, and also Series A's. Angels, you have them in different shapes or forms. You have them angels, you have angel groups, which is those groups that aggregate those angels, and perhaps family offices where you have an individual investor that made a lot of money that ultimately has put together an operation to really institutionalize to a certain degree their investment. So again, angel investors, they're great. Typically check sizes anywhere between, let's say, $100,000. It can go all the way up to, especially if you're doing family offices, to $10 million, especially if you're going after like big family offices, which you see them. But angel investors could be a great resource to raise money when you are in the early stages of building up your business. The next one is venture capital firms. Venture capital firms, they're really great, but again, they're going to want to have your business validated, at least 1 million plus in revenue. Venture capital firms, they're really amazing when it comes to resources and what they bring to the table. They have a big Rolodex. They can help you with really plugging in a lot of people into your business. They're going to want to sit on your board, provide a strategic guidance, help with the issues that you're dealing with as a corporation. And they're really a phenomenal resource when you're Series A and beyond. And again, probably one of the questions that you want to ask the VC is, would you mind making an introduction to a founder of a portfolio company that you have invested in that has failed? Why? Because you want to talk to that founder and you want to ask that founder, how did the investor behave during the tough times? Did they roll up their sleeves and did whatever they could to turn things around for that company? Or did they literally treated that company as a write-off, let them to die so that they could allocate that time on other companies that were performing better? So again, when you're on the good side of the mountain, everyone loves each other. When you're on the wrong side of the mountain, you would see the real human being and make sure that you have a clear understanding and evidence from a founder that failed. How did that investor behave during the tough times? Lastly, you have the private equity firms. So the private equity firms, they typically are going to be more at a Series B and beyond. They're going to be investing when there's more like 2 million EBITDA, meaning like 2 million profit, not revenue, profit in the business. So that's going to limit the amount of companies that are able to make it to that point. Now, private equity firms, they invest in numbers. Venture capitals, angel investors, all of those, they invest in people. So that is a really big differentiator from one to the other. Typically, private equity is going to be more when you have a profit of 2 million plus in your business. Now let's talk about the biggest mistake that founders make when fundraising, and that is going with a crazy high valuation. Because here's the thing, it's not about the round that you're raising today, it's about the round that you're going to be raising tomorrow. Because the way that you raise today is going to impact the way that you can raise tomorrow. So again, if you go with a really big high valuation today, the problem that you're going to cause is that you're going to increase your expectations by a mile, and then, you're going to put yourself into real trouble. So again, it's better, as I always say, to have 1% of a billion than 100% of nothing. So don't worry too much about dilution. Really worry about getting the right people in, getting the right people to help you with the right networks. And again, positioning yourself and your business at a really nice place to be able to achieve all the goals and all the metrics that people are going to expect on the next round when you're going to go out in 18 to 24 months from where you're at. So again, thank you so much for watching our video today. If you liked it, please subscribe, please share and drop out a comment. And also, if you would like to chat, about your business and have a free consultation about what's possible, whether on raising money or maybe selling your business, going through an acquisition, let's schedule a free consultation. You can go to alejandrocremades.com/consulting and pick a time, and I'd love to chat with you. Thank you so much for watching.